All right, well, welcome everybody to today's presentation. This is part of our employer outreach series we're calling Financial Check-ins with FAME. We are doing presentations on a monthly basis. We will take a little bit of a break over the summer, but we're so glad that you're here with us today. And many of you are people that we work with, as well as others that we haven't met yet. So we are just thrilled to have you here as we take on the topic of balancing college savings with retirement savings. Today, Eva Giles is going to be presenting with me. Eva is the College Savings Program Manager, and I'm Mila Tappan, and I'm the Manager of College Access and Outreach. And with us is Martha Johnston as well. Martha is our boss, and she is our Director of Education, and she is going to be monitoring the chat. So we are in webinar mode, which means that everyone is automatically muted and we can't see any of you, but we would love to have your questions. So if you could please enter your questions in the chat. What we will do is we will take as many questions as we can during the presentation today, and then any that we don't get a chance to answer today, we will follow up in an email. So with that, I'd like to go ahead and get started because we have a ton of content to try to get through today. So with that, I'm going to turn it over to Eva to get us started.
Thank you, Mila. I appreciate it. So what you're seeing on the screen right now is our legal disclaimer. Neither Mila nor I are financial advisors. So we're actually here sharing information and resources from the lens of saving for college, and really from working with families and hearing about their questions and concerns. So if you do have any specific questions around tax or accounting, we always recommend that you and refer you to your tax advisor. Next. So today's agenda is packed, which is great because these are all really important topics. Mila and I will be covering different slides in the presentation, but often we'll chime in with each other to share ideas or to ask some additional questions. And as Mila just pointed out, Martha is going to be running the chat. So if you have questions or ideas or resources that you want to share with us, please feel free and we'll make sure that that's shared with everyone. So we're going to start off by talking about competing financial priorities, both the college savings and the retirement. We'll move to options for saving for college, talk about the impact of college savings on financial aid, and then spend a little bit of time talking about Maine's Section 529 plan, Next Gen 529, as well as resident benefits for Maine residents. So we're going to go ahead and jump right in. Becoming informed to establish a plan is really important with balancing those competing priorities. So you're going to hear us mention throughout the presentation some of these key topics that we're going to be talking about here. We're going to begin by spending a little time talking about time horizon. And what we mean by that is the length of time that you have to actually build the resources for those goals. Whether you're in your 20s and retirement is about 40 years away, or you may have an infant and college is 18 years away, or you may be the opposite. You may be in your 40s and have a middle school student. Your plan really does vary depending upon how soon you're going to need those funds. So when we're talking about that, we're talking about time horizon. We're going to be spending some time talking about cash flow. Do you really have a good sense of your budget and know what is coming in, what's going out, and how much is available to commit to specific goals? If not, that may be a great place for you to start out by really getting a sense of how cash is flowing in and out of your household. Next, we're going to talk about some tax considerations. When you're evaluating some of the different savings options we're going to be talking about, there are different ways that they're actually treated for tax purposes. Knowing some of those tax advantages and some of the options that are available really can help you to decide which option may be best for your family. So that's what we're talking about with tax consideration. We've listed here impact of compounding. We have a lot of families who talk to us about saving in their checking account. And while that does give families flexibility to access funds quickly, you do lose out on money that could be earning interest or could be reinvested and allow you to build on that new growth. What we are calling is compounding returns. So thinking about using savings options that encourage that compound earnings or those compound returns is an easy way to actually increase the value of the funds that you're committing to savings, because it's not just your contributions, but all the growth that is increasing on top of those contributions. We'll be spending some time talking about matches and incentives. These are extra financial rewards or benefits that come from outside sources. It may be a match from an employer, a grant that is specific for certain kinds of savings behavior. Matches are another great way to build on your financial commitment using resources from other individuals. And with every time we're talking about competing goals, we really need to talk about priorities. Priorities really differ depending upon the specific circumstances. So we may be thinking about, does your family have an emergency fund? Do you have high interest debt that you're looking to manage? That cash flow analysis that we talked about before is a great way to start thinking about some of those short-term and long-term priorities. Priorities do change over time, especially as the situations in your family change. So it's always important to know that priorities can be revised and adapted as situations go forward. Next. We're going to begin by talking about similarities in the planning process. The components that you see here on the slide, becoming informed, creating a plan, establishing reasonable action steps, implementing those action steps by reviewing and refining, they're all part of the same process, whether you're saving for retirement, saving for college, or looking at other financial goals. Research shows that those with a plan actually have a much higher likelihood of reaching those goals, especially when the plan is based upon informed decisions, realistic action steps, and are actually moved to implementation. The review and refine steps that we have listed here really pertain to making changes as those circumstances change over time. That's what we talked about on the last slide. So for example, this may be a year when you no longer need to pay for full-time childcare. Maybe you got a raise. Whatever the changes in your financial circumstances, you should review and refine your plan periodically. Next, we're going to talk about some differences you may want to consider. Again, we're going to start with that time horizon. If it's a short time and you don't have long before you're going to access funds, you may want to be more cautious and limit the risk associated with investing, since you won't have as much time to regain if you experience any loss. Talking about the term pay down, which is the time over which the funds are actually going to be used. When you're thinking about longer term goals like retirement, those resources need to cover a longer period of time, possibly 20 to 40 years. Whereas a goal such as college savings, the pay down period is usually around a 4 to 5 year time slot. Again, when you have a shorter time slot in which you're going to be having pay down, similar to time horizon, you may want to limit the risk with any of those investments so that if you experience a loss, it is not affecting you in that short term. Available resources, that's really thinking about what are some of the knowns and unknowns. It's been a long-standing belief that many financial professionals share with us often that you can't receive financial aid to finance your retirement. But that may be a resource that you could use to pay for college. So becoming informed and learning about what resources that may be reasonably expected is very important when you're thinking about your plan and how you're projecting for the future. And then we've spent a little time really getting folks to think about some of those unknowns. Although it may not feel it, college costs are actually pretty well defined. Retirement, on the other hand, has far more unknowns. Trying to estimate how long folks are going to live, maybe what their health situations are going to be like, or specific health care needs, as well as what the individual living situations and the cost for the care that people will need over time is some of those unknowns that people try to project. Even well-researched plans will still have unknowns that have differing degrees of preparedness, but trying to determine best estimates for those anticipated costs really help plans to be more successful. One repeated theme that I have heard from families that doing this type of planning can feel very hard. Families sometimes describe being overwhelmed or share that they don't know where to start. The good thing is that there are many resources available to help families become more informed and even sometimes to assist with completing the process. Becoming informed, especially on items such as college costs and financial aid opportunities, there are groups such as FAME, the colleges themselves, and many national groups such as College Board that really help individuals to think about, again, what some of those anticipated costs are going to be, what some of those reasonable resources are to expect. So those are some of the groups that you want to tap into when thinking about estimating and setting up that plan. For retirement, we have a number of the resources listed here, and I think Martha is actually going to be adding some links in the chat. One of the links that Martha is going to be referencing is a tool that we actually use at FAME called Enrich. This is actually a free financial themed courses available to Mainers through a sponsorship with FAME. I personally have taken a number of the modules and have found them to be very easy to use and actually filled with pretty high quality information. So I encourage you to check them out, as well as a number of the other retirement resources that we have listed here and the links in the chat. So once a family has gone through the planning process and has implemented the action steps to address the competing savings priorities, this is an example of what it may look like. Again, it's a hypothetical example, really based upon a family that's thinking about their competing goals. Through the cash flow analysis process, this family determined that from their net income of $60,000, they would be able to commit about 20% of their resources to savings. That means they actually had gone through and have a plan for living off of $48,000 or about $4,000 a month. There are many recommendations or general rules of thumbs for allocating resources to savings. This particular one that this family is thinking about is really the 80-20 rule, where 80% of net income is really dedicated to needs and wants, and 20% is committed to savings. But that savings has to meet these competing savings goals. Again, we're not recommending 20%. That may not work well in your particular circumstance, but having a plan to know how you're going to address current needs, as well as a percentage that you commit to work towards savings goals, really does help folks to think about how to allocate their resources and what options they can use. So again, sticking with our particular example here, when they went back and thought about the factors that we've talked about on the slides before, they knew in their time horizon, they had both short-term and long-term goals. This family is in their 30s and has a child in elementary school, so they really were looking for a balanced investment where they could reduce risk over time, have some funds committed to long-term commitments that they couldn't tap, but also have some funds that they could access quickly if needed. They also took a look at their tax advantage and considerations for that. They did some research and found out about tax advantage plans that were available to them through their employer's retirement options. The particular plans that they could access did allow pre-tax contributions, likely in a 401k, reducing their adjusted gross income, which helped with some of their federal tax consideration. Their additional retirement contributions actually went into a Roth IRA, which allows for tax-free growth in distributions during retirement. When it came to thinking about their college savings options, this family actually selected a 529 college savings account that allows for tax-free growth when using a qualified for higher education expenses, and also had matches and incentives associated with it. So they did think about those matches and incentives. In addition to their 529 plan, they also took advantage of opportunities provided by their employer, who would match the contributions that they made into their retirement accounts. So one of the considerations when choosing the dollar amount that they contributed into both their retirement and their college savings is thinking about the dollars needed on an annual basis to maximize those matches and incentives that were available to them. As we've talked about, the importance of compounding, this family balanced the need for emergency savings in their quick access accounts at their bank, as well as long-term budget expenses that were in higher yield accounts with more restrictions, but higher rates of return. They also selected retirement and college savings that were in balanced investments that automatically reinvested the growth and again compounded the earnings. So this family deliberately chose not to maintain those longer term investments in savings accounts because they wanted to take advantage of that compounded growth. And they went through this process really thinking about those priorities. They had diversified options, so not everything is in one basket. If budgeted expenses and emergency savings start to get under control and their income grows, they may be able to adjust later on and move resources from those short-term priorities into longer-term retirement and college savings. This piecemeal approach is common for many families and is a theme that you're going to hear repeated today, not only for savings, but for paying as well. It's a theme that Myla and I use and share often. Next. Now we're going to switch gears and look at a national picture with a survey from Sally May. And I think Martha is actually going to put the link to the actual survey in the chat feature. Sally May is a financial group that has been involved in college lending since about the 70s. And they've actually been doing surveying of families for about 13 years. The data that we're going to be sharing today is from the 2020 How America Pays for College report. It's a very user-friendly report, so I encourage families to visit the site and review all of the information. Today, we're just going to hit on a few of the key highlights that can give you some context to our other discussion, but there's a lot of rich information in the report. So this first slide that we have shows that families really still feel that higher education is an investment in the future and has a real return on the investments that are made. Next. We see here that families are proactively establishing a savings plan. Again, those with a plan have a higher likelihood of achieving the goals that they set for themselves. We took a little time in this chart to look at how families are paying the college bill. Again, you're going to see it's a piecemeal approach. Scholarships and grants play a significant role, with the survey data showing it coming in around 25%. The majority of costs are being paid by parents and students. Some of those costs are coming directly from the family budget in some of the monthly tuition plans, as well as from resources saved over time. Again, linking back to that college savings that we've been talking about. And there's also borrowing. As is shown here, students play an important role in contributing to the cost of college, but typically are not able to take that cost on all by themselves. Couple of important things to point out from this slide. It is not typical for families to cover everything with scholarship and grant. Financial aid is important. It's a resource we spend a lot of time talking about. Mila's going to go into a lot of detail about it. But folks who talk about getting the free ride, looking to have either merit or their activities like sports give a full scholarship, those are very rare. The other piece to be thinking about from this particular slide is family savings provides options when it comes assessing to the amount that families need to pay. So if you have to decide how much is coming out of your current cash flow, how much is going to be involved in borrowing, any dollars you can save to put towards that really reduces the amount coming out of that monthly budget, as well as what you're going to have to repay in the future. Next. Loans are a resource that families often use to pay for higher ed. Student loans are considered to be a type of financial aid. And again, Mila will go into some details. As shown here, they're generally used to cover about 13% of the total costs. Federal student loans are used the majority of the time, but there are private loans, an example being the Maine loan program that FAME helps to administer. That's also an important resource. There are other types of loans that some families use. An example would be maybe a home equity loan. Again, we just remind folks to be careful. Depending upon the loan type and the interest rates, those other types of loans may be higher cost. Families may not have access to specific features such as consolidation or other type of repayment options. So when families are thinking about borrowing money, we always recommend doing it with as much information as possible, making sure you're making an informed choice. And just a reminder, parents who borrow or who co-sign on a loan are financially responsible. So you want to take that responsibility very seriously, especially if there are long-term consequences if a student that you're thinking is going to take on that debt is not able to do so. Next. So now we're going to take a look at some of the college savings options that we've seen families use. We're going to take a look at the Coverdell, custodial accounts, savings bonds, the 529, mutual funds, traditional IRA, and Roth IRA. So a Coverdell, just to give folks a little bit of context, is an education savings account. It's generally available through a financial institution, and the account offers tax advantage earnings when it's used for qualified higher education expenses. A custodial account here is an account where the account ownership eventually moves to the beneficiaries. So a typical example would be what's known as an UGMA, UGMA, which stands for Uniform Gifts to Minors Act, or an UTMA, UTMA, Uniform Transfer to Minors Act. When we're talking about savings bonds, we actually mean government bonds that are sold to citizens with a guaranteed rate of return. Typically, it would be a Series EE bond that you can buy at the bank. They're sold at 50% of the face value and mature to full value after about 20 years. The 529 Education Savings Plan is a state-sponsored qualified tuition plan. These are investments with tax advantages, including tax-free growth and tax-free withdrawals when used to pay for qualified higher education expenses. You heard me reference it before. Our state's plan is Next Gen 529. We're going to talk about mutual funds, which are just regular investment accounts. A traditional IRA stands for an individual retirement account. These are investment accounts to contribute pre-tax contribution, so the investment grows tax deferred until the funds are withdrawn during retirement. Whereas a Roth IRA, or a Roth individual retirement account, contributions are made post-tax, so future withdrawals are tax-free. So the chart here is tight. It's got a lot of information on it. These are comparison worksheets from savingsforcollege.com. Martha is actually going to put the link in the chat. I highly encourage families to go online to view the information. Once you're online, the comparison tool allows you to customize how much information you receive. So we've actually included a lot of information for all of the different investment types, but you don't have to do that if you go online and do the comparison yourself. You can go and compare just 2 choices at a time or just a few features at a time. So you have the ability to really do an apples to apples comparison for each type. As we go through today, I'm not going to cover all of the information on each slide. I'm actually going to highlight just a few components, specifically because you can do that, that individual comparison on savingsforcollege.com. So in this first slide, what I want to call out is the federal tax treatment. As I've mentioned, tax consideration is one of the factors that may help to determine which option works best for you. Many of the options do have tax advantages for higher education expenses, including the retirements. That's why we've put the Roth and the traditional IRA here as a potential college savings tool. One of the tools that we typically do the most comparison is the Coverdell to the 529. Both of them use non-deductible contributions, whereas the traditional IRA does use pre-tax deductible contributions. The next 2 columns that you see here are the federal gift tax and the federal estate tax. Those are typically factors that are most important to those interested in large gifting amounts within the same year or estate or legacy planning. So again, that may be of most interest to grandparents or families who are thinking about investment options with a further down the road planning. The next chart that we're going to look at, the first column is talking about maximum investment. So this is an area where one of the primary differences between a 529 account and a Coverdell comes into play. The Coverdell is limited to contributions of $2,000 per year until the beneficiary is 18. The 529 is limited by the plan's maximum. So for example, NextGen 529 has $500,000 and does not have an age limit. There are annual gift tax that folks may want to take into consideration, but they're not limited in the investment option. I also want to call out the annual maximums for the traditional and the Roth IRAs, which are $6,000 or $7,000 per year, depending upon the age of the contributor. So if you make the maximum contribution and are earmarking some of those funds to be used for higher education expenses, you need to realize that once those funds are removed from the account for higher ed, those funds cannot be recontributed, even if later on you determine that you really need the money for retirement. So one of the considerations to think about is having separate accounts dedicated for a specific purpose, having money dedicated specifically to retirement in a retirement account, and money dedicated, say, specifically to college savings in a college savings account, so that you can maximize the benefits under each of the different account types. Another consideration on this chart is the qualified expenses. So qualified expenses do vary by account type. I'm going to call out that Coverdell includes more option for K-12 expenses than some of the other education savings plans. But a recent change to 529 accounts now allow $10,000 over the course of a lifetime to be used for student loan repayment of the beneficiary, as well as each sibling of that beneficiary. Also, there are opportunities to cover expenses associated with apprenticeships associated with 529. So depending upon if you have an interest of using the funding for K-12 expenses that include more than just tuition, or you're interested in using it for some of these other repayment features such as student loan or apprenticeship, that may help to determine which investment type is right for you. On the next chart, we start off with a column that's talking about ability to change beneficiary. And this is often an important consideration for a family if there's concern that the beneficiary may decide not to go on to higher education, or if not all of the funds are to be used by the single beneficiary. If you have the chance to choose beneficiary, you have more flexibility with those particular accounts. The second column that we see here is talking about age restrictions. So we've mentioned for the Coverdell that contributions have to be made before age 18, but a Coverdell account can only have distributions made before the beneficiary's 30th birthday. So this account type is really designed for what we would call a traditional age student, not necessarily for those who are thinking longer term, maybe towards grad school or other kinds of professional training, or for non-traditional age students looking to go back to school. The last column on this slide is talking about income restrictions, and folks should be aware that some accounts do have phase out on their eligibility at higher income levels. So if the higher income level is something that pertains to your family, you would want to spend some time exploring where some of those tax advantages and those eligibility provisions stop for you. The next slide is going to kick off with the financial aid treatment. Again, Mila is going to cover this in a lot more detail in her section. So I'm going to skip that for now, but know that financial aid consideration, that different account types are treated differently for financial aid consideration. So if that's something that is of concern, make sure you explore that before making your option. The second column that we have here is investments. Know that most of the accounts that we've been talking about today are investment accounts with a variety of different offerings and a lot of different risk tolerances. So depending upon, again, some of those considerations of time horizon, pay down, and your overall comfort level with adding risk in your financial package, you have a lot of different choices available through those investment options. The last column is really looking at non-qualifying expenses. So remember that most of the tax advantage accounts usually have provisions so that if an account is used for an expense, it's a purpose that it was not originally developed for, the account owner often loses the tax benefit and sometimes pays an additional penalty because they used it for a reason that wasn't acceptable under the account type. This is important to know if you are thinking about using the expense differently. So having that information available is important. Again, I mentioned these comparisons are available on savingforcollege.com. When you're ready to make a decision of what your investment type is, I do recommend that folks spend time there. Another great resource, and I know that Martha is going to put it in the chat feature, is IRS Publication 970. This is actually a pretty user-friendly piece to read from the IRS. It addresses education-related tax considerations as well as tax credits, such as the American Opportunity Tax Credit and the Lifetime Learning Credit. So with that, I'm going to take a pause and see if there are other questions, comments, or resources that have come up in the chat.
All right, so we did get a little bit of feedback that some of the dropping of links could be a little distracting. So you might notice I might be a little slower dropping a link, and I'm trying to time it when it would be least distracting. So I thank the person that gave us that feedback. It's really important. And we did just get a question, and that is the 529 tax benefit upon withdrawal or upon contribution?
So the contributions are going in post-tax, and those contributions, because you've already paid tax on them, you won't be paying tax on them again. The earnings that occur on those contributions over time are occurring tax-free. So when you withdraw, you'll not be paying a tax on those earnings if you are using it for the qualified expenses. So you're not getting them as a pre-tax reducing your AGI contribution, but you are getting that on the earnings, and you'll see that when the withdrawal happens for a qualified expense.
Great, that was our only question.
Wonderful, then I'm going to pause and turn it over to Mila.
All righty then. So when we think about saving for college, it might be easy to assume that everyone agrees that saving for college is a good thing, right? You know, when you are saving for college, you are potentially going to be reducing student loan debt. You know, we talk a lot about the fact that every dollar that is saved is a dollar that doesn't need to be borrowed and then repaid with interest. And we talk about the fact that small reductions in student loan debt can really make a huge difference when students graduate. So when students are graduating and it's that time of year and they're starting to get jobs and figure out their budgets, you know, that student loan payment can have a really big impact. So the smaller the student loan payment, the better. So obvious that we should be saving for college, right? How many of you, though, have heard this said? How many have you heard? How many people have heard people say, well, we're not going to save for college because it's just going to mess up our financial aid eligibility, that savings negatively impacts financial aid. And so we're not going to do that because we'd be shooting ourselves in the foot or something like that. Well, in reality, what we want you to know is that savings have very little impact on financial aid eligibility. Assets in general have very little impact on financial aid eligibility. Instead, it's income that is the primary driver of financial aid eligibility. So I could just say, just take Mila's word for it. You know, just trust me on this one. But if you're like me, you want to know why I feel so confident saying this and why we talk about it so often that savings has little impact on financial aid eligibility. So here's the reason why. So the federal financial aid formula, so when people file the FAFSA, they're filing for the federal financial aid form, and that formula is publicly available. So if anyone was interested, we can actually share that formula. And what that formula shows is that families that earn under $50,000 per year typically do not have to provide any savings or asset information on their FAFSA. So any of you who have worked with students doing a FAFSA, you may be familiar with the fact that you'll get a question sometimes that will say, do you want to skip the remaining questions about assets? And the reason is because people are earning under $50,000 and they're meeting the criteria that they don't have to provide asset information at all. So needless to say, if you don't have to provide asset information, it's not having any impact on financial aid eligibility. That $50,000 cutoff is going to go up to $60,000 in the 23-24 FAFSA. So that's really good news. And if we think about, you know, so many families in Maine make under 50 or certainly under $60,000 per year. So we've got a huge chunk of our population that don't have to provide any asset information at all. But what about if you're one of those families who does make over $50,000? You know, what for you? Do you have to be worried about this? And the reality is we still need you to not worry because not all assets count. So one of the big things to know about the FAFSA, if you're not that familiar with it yet, is that many assets are completely excluded from the FAFSA. So possessions, cars, boats, things like that, completely excluded from the FAFSA. They just don't count. Additionally, a family's primary residence is excluded from the FAFSA. So if families have equity in their home, that is not important because it's not going to impact the FAFSA financial aid eligibility at all because it doesn't have to be listed. Additionally, all retirement plans are excluded from the FAFSA as well. So when most of us sit and think about what are our assets, our home and our retirement accounts are often our most substantial assets, and those are completely excluded from the FAFSA. Additionally, if you have assets, though, that are beyond those ones that are excluded, and you earn over $50,000 a year, what happens for you? Well, what happens is when the FAFSA is filed, there's something called an education savings and asset protection allowance behind the scenes. So what that means is that there's a portion of your savings, even if you have to list your savings. So you might be thinking, what sorts of things do count on the FAFSA? So we're talking about checking accounts and savings accounts. We're talking about 529 plans and Coverdell's and things like that. And we're talking about second properties or other types of non-retirement investments. So if you do have those and you are required to provide asset information on the FAFSA, you're going to find that a portion of those are protected. The federal government doesn't want you to have to deplete all of your resources in order to pay for college. So a portion are protected. And the amount that's protected is based on marital status and the age of the older parent. So for example, for this current year, if the oldest parent is 46, the countable assets that they have, the first $6,300 are protected and excluded completely from consideration. As parents get older, that amount goes up, and every year that is adjusted. So we're hoping that that will continue to go up, so people will feel comfortable that even if they do have some savings, that some of those savings are protected and not expected to be available to help pay for college. But let's just say we're at the point that we make over 50,000. We do have assets. We have assets beyond the asset protection allowance. Should we be concerned then? And the reality is that even if you have countable assets, only a small portion of those assets are going to be assumed to be available to help pay for college by the FAFSA formula. For a matter of fact, that rate is a maximum of 5.64%, and in most cases is much lower than that, okay? So for all of these reasons, we want you to not worry about saving for college having a negative impact on your financial aid eligibility. But sometimes it's that picture that's worth 1,000 words. So we put together this chart to demonstrate what it looks like when people do file a FAFSA, depending on their specific circumstances. So when you file a FAFSA, the expected contribution, that EFC that we talk about, comes from 4 places. It's based on student income, student assets, parent income, and parent assets. So what we're going to do with this chart is focus on contributions on the parent side, those contributions that come from income and those contributions that come from assets. So up across the top, we've got income stable. So for all 4 of our families, their income is $67,000 per year. If you're earning about $67,000 per year, you're a family of 4 with 1 in college, and you're living in Maine, your EFC, or your expected contribution from income, currently is $4,464, okay? So that's going to be the same for all of our 4 families because they're all earning the same amount. But what we wanted to do on this chart is to show you what happens if they have varying level of assets. So our first family has no assets at all that are countable, right? They might have a home, they might have retirement, but they don't have countable assets. This next family has, let's just say, we're just going to talk straight cash in the bank. They have $25,000 sitting in a savings account. The next family has $50,000, and the 4th family has $100,000. So I want you to jump down here and look at the expected contribution from assets. And what you're going to see here is, of course, if someone doesn't have any assets that are countable, their contribution from assets are going to be 0. But look at the family that has $25,000 sitting in a bank. Their EFC is only going to increase by $577. The family that has $50,000 sitting in a savings account, their EFC is only going to go up by a little over $1,400. The family that has $100,000 sitting in a savings account, their EFC is going to go up by about $3,400, $3,500, but they have $100,000 sitting in an account. So what we hope this shows is that it's not assets that drives the EFC. Income is the primary driver of the EFC. Parent income in particular is what drives the EFC. Now, a lot of times I've heard families say who have saved that they saved, and that's the reason that they didn't get more financial aid eligibility. And I think it's what perpetuates this myth. But what the reality is for those families is they weren't going to get any more financial aid. They did not get financial aid because they saved. They just didn't get enough financial aid because unfortunately there's just not enough money in the system at the moment. Schools very rarely are able to fill all of a family's need. But by having savings, they haven't, not only have they not missed out on money, and now they've got options available to them. So we just really want families to think about saving for college because it is so incredibly important. Now, when we're thinking about saving for college, I'm not one of those people who would have you go to a site and use one of those calculators to figure out how much you need to save to pay for college in full through your savings. Instead, as Eva mentioned earlier, we really like to think of paying for college as a piecemeal approach. That's where we see families the most successful in paying for college, is when they approach it with lots of pieces that can help pay for college. So I like the pie analogy, right? So if I've got a pie sitting in front of me, I want to have as many pieces of pie as possible, right? And if I have a pie and I have more pieces, each piece can be a little bit smaller, right? So in this example here, imagine that the bill for the fall was $11,500. The student applied for financial aid. They got a good amount of grants and scholarships. As Eva mentioned earlier, virtually never do students get enough grants and scholarships to cover the whole bill, but the student got a nice chunk. The student's also borrowing their federal student loan for $2,750, which is the first year amount. The student was really good about over the summer saving their earnings. And so they have $1,000 that they're going to be able to put towards their bill. And maybe they or their parents in combination or their parents alone are able to do a tuition payment plan. They've been, planning for this day to come. They've maybe gotten paid some of their debt paid off so that they have some money available in their budget so that they can do a tuition payment plan. So that's $500 a month. But even after all of those pieces, there's still a $1,500 balance. And if they have savings and can use savings to pay that remaining balance, that gap is what we sometimes call it, then what that means is they won't have to look at other sources of borrowing. So when we talk about federal student loan, when we talk about student loan debt, it's not the federal student loan debt that typically is the issue for undergraduate students, at least. Those amounts are limited and usually considered to be very reasonable amounts to repay after students graduate. Where people tend to get into trouble is when they're borrowing above and beyond those federal student loans, and they're trying to fill the gap because they don't have any savings available to them. So again, I'm not looking at having families try to save all of the money, the full $11,500 to pay that full fall bill, but we can see in this example, which is a pretty realistic example, that having $1,500 in savings would really make a huge difference and could prevent families from having to borrow above and beyond those federal student loans. And that's a lot of what our conversations are about when we're working with families. So, we hear this talked about. I think Eva might have even said it earlier, which is, we can't borrow for our retirement, right? We can borrow for college, but we can't borrow for our retirement. So maybe we should just, put everything into our retirement instead of worrying about college because we'll just borrow what we need. But here's just a quick example of how much more, and we all know this, right? How much more it costs us to borrow money than to save money. So when we save money and we put aside $100 a month for just even 4 years at 3%, we know savings doesn't tend to have that huge return, but it still is some, then we're looking at about $5,200 or so, right? After 4 years of doing that. But when you borrow that money and you repay it with interest, let's just say 6.5% at this point in time, over 4 or 10 years, as some of the federal student loans take to repay those loans, you can see how much more that is costing you. So we just want to be sure that people are putting money into savings because borrowing does have that additional cost. And it costs a lot more in the long run than savings does. And again, every little bit is going to help students once they've graduated. And they're trying to put together their budget and they're trying to make their ends meet. The difference of having a $50 less student loan payment really is a huge difference maker to students when they're coming out of school at 22 or 23 years old. So how do we save for college? And I'm looking at my time here, and I don't have a whole lot of time, but I want to get as much information as I can out to you about NextGen that Eva has already mentioned. So NextGen is Maine's 529 program. She touched on what a 529 was. In those charts, you could see some of the details about how 529s work. Going to savingforcollege.com, you can revisit all of that yourself. 529s are a great way to save for college for your children. But I also want to be clear that 529s are available for adults as well. So you yourself can have a 529 account. You yourself can have a NextGen 529. So these are not limited only to children. And one of the things that we're really excited about with NextGen is that there are benefits for Maine residents. So there's some matching grants and additional benefits available to Maine residents that make this program, I think, even more exciting. So when you open up a NextGen account, you have a couple of ways that you can open up accounts. You can either open up an account all on your own by doing a direct series, a client direct series, where you open up an account, you make your investment selections. You take care of it all by yourself, although there are some great resources available, but you can open up the account yourself and you can do it all online. In other cases, people sometimes want to work with a financial advisor to help them make some of those decisions. So that option also exists. So people can also work with their financial advisor to open up a NextGen account. And when it comes to investment options, there are a whole variety of options. So you can learn more about these if you were wanting to open up an account. Again, we have some great resources available. As you can see, there are age-based accounts. There are accounts that are much more conservative. Lots of options here. But the really fun thing, great thing, exciting thing about NextGen 529s is, as I like to talk about, are the grants that are available for Maine accounts. So Maine residents have some additional benefits that they can receive. Now, in this case, either the account owner or the beneficiary has to be a Maine resident. And that's an or statement. Either the owner or the beneficiary just needs to be a Maine resident. And you can see that there are some initial matching grants, there are automated funding grants, and there are next step matching grants. So let's talk a little bit about these. But before we do that, I want to take a moment and I want to talk about the ELFON grant. Now, the ELFON grant, you might be wondering, why is she talking about the ELFON grant? How does that connect to NextGen? Many people are familiar with the fact that the ELFON grant is a $500 grant that's awarded pretty much automatically, always caveats, to all babies who have been born Maine residents since January 1st of 2013. So many kids out there have these accounts and might not even realize it, right? So if you know anyone in your life who has had a baby born a Maine resident since January 1st of 2013, they likely have a $500 ELFON grant. It's held by the ELFON Scholarship Foundation, and they take care of holding on to that money, investing that money, and then when the child is ready to go off and pursue higher education, that money will be available to them. So you might say, okay, so again, Milo, why are you talking about this and how does this relate to NextGen? Well, what's really cool about having an ELFON grant is you can open up a NextGen account using that ELFON grant so that you don't have to make any contribution when you open up an account. So you can open up a NextGen account without having to put in any money. The reason that we talk about these things in combination is that an ELFON grant can't be added to, right? It's a grant, it's wonderful, but families can't add to that ELFON grant. But what they can do is open up a NextGen account. They can use their ELFON grant to do it, and then they can contribute, and all of their family members and other people in their lives can contribute to their NextGen account and grow the savings plan that way. So we talk about the ELFON grant because it is the way in which many people open up their NextGen account. And again, if they have an ELFON grant and they open up a NextGen account, they do not have to make an initial contribution. They certainly can, they're just not required to. But what about everybody else? What about you yourself? Or what if you have kids that were born before January 1st of 2013 and don't have an ELFON grant? Well, if again, Maine residents, owner or beneficiary, eligible for a $100 initial matching grant. So when you open up a NextGen account and you put in the $25 that's required to open up an account, you get a one-time initial matching grant. And this is one time per beneficiary. So let's just say, for example, if my kids have two NextGen accounts, which they can, only the first one, where they're the beneficiary named, will get that initial matching grant. If a second account's open, that's fine, no problem. But because that beneficiary has already received an initial matching grant, they don't get a second one. What I love about these grants is they're awarded automatically. There's not another piece of paper that you have to fill out. Instead, you just open up the account, put in the required contribution if you need to, and automatically that 100, and you would need to in order to get that $100 initial matching grant, unless for the remainder of this year, you already have an Alphon grant. So not to be confusing, but for this remainder of this year, these are usually or statements. Usually you either have an Alphon grant or you get an initial matching grant. But this year, even people who have an Alphon grant, if they put in $25, they can also get this initial matching grant. So we'd really love to have any of those families out there that have an Alphon grant that have not yet opened up a NextGen account. We'd love to have them do that. So they can have their Alphon grant, but they can also through January or through December 31st of this year, get that $100 initial matching grant, again, if they contribute $25. Okay, so those are grants to open up accounts. And then we know that part of what is really important is continuing to contribute. It's that long term, a little bit at a time, that can really add up. So to incentivize people to make contributions to a NextGen account, we currently have a Next Step matching grant. And that Next Step matching grant matches contributions at 30%, at 30 cents on the dollar, and for a maximum grant of $300 per year. So, if families are able to put in $1,000, they're going to get that full $300 grant. But if they aren't able to put in the full 1,000, they will still receive 30%. So let's just say they are able to put in $100, they're going to get a $30 matching grant. Again, this is per beneficiary, okay? So if they have multiple accounts, it's the account that the contribution goes into first in a given year. And they are going to find that this grant is available every single year. So every single year we have been having this grant available. And so that's really exciting and can really make a significant difference. These awards are, again, automatic in the sense that you put the money in, and then at the end of the calendar year, people on Eva's team and others go in and they look at all of the contributions and they assess what is available, what's been contributed, and then they determine how much the grant can be, and it shows up automatically in the owner's account. So that really makes it a whole lot easier. It is 1 o'clock, so I'm concerned about that. I'm going to keep going, but I just want to say that I recognize, I'm sorry, I've been trying to talk so fast. I recognize that some of you may have to leave us now. I'm going to continue through, just talk about a few more things related to NextGen, but I totally understand, and I apologize if some of you need to go. Martha, did you want to say something?
Yeah, I know we're running over, but I have one question I'd love to have you comment on, and I've been answering the other questions as they come in.
Okay.
So we had an anonymous question, which was basically somebody, a family of 3 experienced an EFC of about 32,000. And so they're wondering why it would be so high. And my answer, although I consider you my expert because I've been out of an aid office for many years, my answer was that I think it was the family size of 3 and the income over 100,000. Typically family size will have a big impact on that contribution coming from income. So I just wanted to throw that out there. Also, I just recommended that we talk about whether or not it was the actual EFC or maybe it was the amount due after financial aid. And sometimes those two things get kind of conflated.
Right. In a perfect world, the EFC and the remaining balance would be much more similar, but in many cases they're not. Yeah, I would just say a $32,000 EFC means that, yes, the family had a much more substantial income. And as you mentioned, Martha, family size does have some impact. One of the things that happens with the EFC is that as the income goes up, there's an allowance behind the scenes for income that does not go up. So once families hit about $60,000, as their income goes up, their EFC starts to go up dramatically. So for example, a family that's making about $130,000 is going to have an EFC of $32,000, $35,000, even with a family of 4. So this is why savings is so important. People are shocked when they realize how high EFCs are, especially for families that are making, like I said, over $60,000 or $70,000. Those EFCs are completely out of whack with what most families feel is reasonable. But anytime, we are certainly happy to talk more about this. The College Board has what's called the Big Future site, and the Big Future site has an EFC calculator. And so I really recommend that families go out there and they check out that calculator to see what their EFC is, so that they can get a sense of that, because that EFC is going to make a big difference when they apply to schools, because schools, might know that EFC is not realistic either, but they are going to use that to determine financial aid eligibility. Martha, is there anything else that you were hoping that I would mention?
No, that's perfect. That's exactly what I was hoping you confirm. Thank you.
Okay. All right. So for those of you who are able to stay with me, I'm going to take a deep breath and go through the rest of this. So not only do we have grants available to open accounts, grants to support continuing to contribute, but we also have grants available when people set up automated funding. We know that when people set up automated funding, I always use my scenario or my example of belonging to Planet Fitness for years on end in some cases, without having walked in the door for years, because I had it coming out of my account automatically. And it took time and energy and effort to stop that. So guess what? I just kept it going, even though I wasn't using it. So it can really work to your advantage. That set it and forget it mentality. People learn to live not missing that money. And when it happens automatically, it just ensures that the money actually goes into the account. So we want to incentivize that. So there is a one-time grant for, again, eligible main accounts, one per beneficiary, so that if you set up, whether it be payroll deduction, contributions from a checking account or a savings account, then what you're going to find is once you've made 6 consecutive automated payments, no less than quarterly, many people set them up monthly, you are going to automatically get the automated funding grant. And again, what's great about these grants is that you don't have to do anything extra to get this $100 automated grant. It is going to be watched behind the scenes. And once that 6th payment has been made, that grant is going to show up in your account shortly thereafter. So that's one of the things I love about these grants, because I don't know about you, but if it requires additional paperwork and I've got to fill out another form, it really decreases the likelihood of me taking advantage of these things. So the fact that it happens automatically is really awesome. So in closing, I just wanted to mention, actually, before we even talk about that, one thing I wanted to add about these grants is we always want people to use these grants first before they use their money. Now, what do I mean by that? So I've got kids of my own, and as Eva and Martha, and we've been saving for college and we've used our next gen accounts. And so when I look at my next gen account, the first thing I want to do, and I can see this all separated out in my account, is I want to use my matching grants. And the reason I want to use my matching grants first is because my matching grants have to be paid directly to the educational institution, to whatever college the student is going to. Okay, so it has to go directly to the school. And you might say, well, isn't that obvious? Actually, any of your own contributions and your own earnings can go to multiple places, including a check directly to you or to your student. Okay, so that's how those are different. But matching grants have to go directly to the educational institution. Additionally, matching grants cannot be transferred to another beneficiary. So I mentioned I've got my kids. So my 2 boys each have their own account. Theoretically, if I have money left in one, I can transfer some of that money to my other child, if it's my money or earnings from my money. But their matching grants, I can't. Their matching grants are only able to be used for that particular beneficiary. So we just want to make sure that people who have these matching grant funds know that you want to use these funds first. Okay. And so what's nice is when you have your account online, you can easily see matching grants and then your contributions and earnings. It does look like we have a question. So Melissa, do you think you can put that in the Q&A, or Martha, has Melissa already put that in the Q&A?
Yep, we should be all set with Melissa's question. And then what we'll do is we can recap some of these questions in our follow-up email so that everyone has the answer. And then we'll also be distributing the slides to all of our attendees, and we will share all the links to the resources we think you might find helpful related to the topic.
Right. So in closing, I'd love to talk a lot more about NextGen and how it works. So I just want you to know, first of all, if that's something that you'd like to do, if you want a better understanding of what the funds can be used for, if you want to have a better understanding of which institutions, all of those things, if you have any specific questions, just let me know. And we would love to, we even have some recorded presentations specifically on NextGen, if that's something that's of interest to you. But at the end of the day, we just want to be sure that whether it's you're saving for retirement or you're savings for college, that you want to look at tax advantage options. That can really make a big difference. And so please take a look at that and find out what your options are. I think I read something the other day about how many people, what percentage of people don't contribute enough to get their full match from their employer for their retirement, for example. So it's just really good to know what those maximums are. We hate to see people leave money on the table. It's something we talk about a lot. Keep in mind the importance of compounding over time, whether it's interest or just earnings on your investments. When time is on your side, you are in a good place, and that can really make a huge difference as that money compounds and grows. Matches, as we talked about, there are many ways to save for college. NextGen's 529 plan is just one way, but we want people to be aware of those matches because we don't want people leaving money on the table. So to be able to know what those matches are and to take advantage of them can really help your earnings grow over a period of time. Obviously, we talked a little bit about interest on student loans, but there's interest on all sorts of other things like credit cards or car loans or different things like that. So, this is all a big balancing act, isn't it? It's trying to figure out, how do we save? We've got to have that emergency fund, which is the next bullet, because that's so incredibly important. And we've seen that this year. So how do we save but pay off high interest debt? So, I think there are lots of different philosophies on this. Sometimes it's do a little of this and do a little of that. So there's lots of good resources out there, whether you do the snowball effect or something like that, where you pay off, your as many of your small accounts first and then dedicate that money towards your higher one. There's really good resources out there to help you try to figure out some strategies to paying off that high interest debt. And it's never too late to start saving. That's one of the things that this time of year in particular, we're talking with juniors and seniors and their families about college, and it's not too late to start even then. Now, obviously, with compounding, the earlier you start, the better, but we don't want people to give up and say, oh my gosh, I haven't bothered yet, it's too late. Every little bit can make a difference. And so even if you haven't started, you can start now, and it will have a positive impact. And then just adjusting the priorities as things change. As I've gone through my life and we didn't have daycare expenses anymore, which Eva mentioned, we could adjust some of our financial stuff. We're down to just one in college now, so we are doing some adjustments there. So it's really just continuously looking at budgets and revising them to make them work, to fit with our current situation and our plans going forward. So I'd think most of us would love to just take our budget and just kind of forget about it, do it once and put it aside and not have to look at it again. But realistically, we need to be looking at it on a regular basis so that we're making sure that we're adjusting as needed. So that's what I had for today. I am sorry I kind of rushed through things and all of that, but I hope that you found this beneficial. And more than anything, just please know that if we can be here, we are here for you to answer any of your questions and to provide additional information going forward.
Lila, could I answer one quick question? I'll make sure it goes in our recap as well.
Yes.
Sure. So we had one question was, if somebody starts a 529 account and then the child decides not to attend college or leaves after a semester, what happens to those funds? And so Eva obviously can chime in, but there is the ability to switch funds over to what we call a first degree relative, but for lack of better explanation, that could be to another sibling, it could be to yourself, it could be to a first cousin. And as Mila said, in the case of NextGen, you just can't switch those matching grants because those are tied to the beneficiary to which they were originally awarded. But again, I'll take all these questions, make them generic and provide answers. That way everyone can have the information.
And one of the things too,
Martha, I just want to say that, for folks who maybe have a child that's not going to go to school right now, remember with a 529, there isn't an expiration. So the student may choose to go 5 years from now, 10 years from now. So that's another option to consider.
Exactly. Thank you so much for adding to that answer.
Yeah, that's exactly what I was going to say too. So I think sometimes my son took a year off, and they just need a little bit more time. And the ELF fund grant does have a time limitation, unless that's changed, Eva, right?
No,
It
it's
still does?
28. You're
Okay,
right.
so they do have to use that by the age of 28, but as Eva mentioned, that's not the case with Next Gen funds, the grants, or your own money. So I think that does provide that flexibility. And I think the other thing too that's really great is that it doesn't, one of the things I like about Next Gen or 529s in general is that the student just needs to be attending an eligible institution. They don't have to, like with many types of federal financial aid, you have to be attending full-time or at least part-time. But with these Next Gen funds, as long as the student's attending an eligible institution, they can even use them for a course here and there. So sometimes that's what's appealing to people too. They don't necessarily want to go full-time, but they want to take a class or two, and that option exists to use those funds in that way as well. Is there anything else, Martha or Eva?
Well, just to thank this
Just
great
one
group.
last question.
Oh, I was just
Yeah,
going to
this
say,
is a great group.
we've had
questions.
yeah, we've had amazing questions. This has been fantastic from this group. So what's the last one, Martha?
So here's our last question. What happens if there are no other siblings in the household? And if we switch over the account, the 529 to the parents, what happens with the money?
So if you are moving the beneficiary from the child to the parent, that's fine. The parent gets to use that for their own educational resources. We have this happen quite frequently. So to the question that we answered a little while ago, that first degree or those eligible family members include even into cousins. So we have a whole list within the program description that talk about all of those changes that you can make with the beneficiary, and that new beneficiary gets the opportunity to use it for their qualified higher education expenses.
And just one more piece that this might be obvious, but you can also take the money out. So, the matching grants, those are only eligible to go to the institution and be used for, that beneficiary at that institution. But your own money that you put in, you can withdraw that. And the money that you contributed, you've already paid taxes on. So you're not going to pay taxes on that money. Now, if there's been growth, which hopefully there has been, then on those earnings, you are going to pay taxes and you are going to pay a 10% penalty. But, when we talk about, because we get that question a lot, kind of what happens if my child doesn't go to higher ed right after high school? And, so we kind of go through this, okay, you could do this, you could do this, you could do this. But at the end of the day, you can take the money out and just be aware of the fact that that 10% penalty and tax, and that the earnings are going to be taxed. But again, only the earnings.
Great, I think we're in good shape.
Okay. Well, thank you so much, everyone, for being here today. We're glad that you could join us. If you would like to join any of our mailing lists, please go to famemaine.com/join. And we'd love to have you join our mailing list, whether you're a parent, a student yourself, and we will share tips and all sorts of things with you. So thank you, everyone, and have a fabulous day.
Thanks, everyone. Take care.
Thank you all.